So there's this concept known as dumb money, and that's the money that chases the market at the top, often fueled by greed. Um, Getting into a bull market late and trying to chase gains. And essentially, what happens at the top is that after this dumb money gets in, the smart money or the people that got in earlier are already selling their positions, and the market goes into equilibrium at the top where sellers and buyers are in equilibrium, and the late money can't push the market any higher because sellers are starting to take control. Then you get a stage 3 topping process, and finally when the sellers finally gain the upper hand, the market transitions into a stage 4 and you get a bear market. And the point of stage analysis is to using these long-term trend or moving average, you can try and decipher when to get in early in a bull market and be the smart money and not be the dumb money chasing in late when the market is actually topping. If you go back and look at the history of the S&P 500, you often hear market pundits talk about how markets don't top until the dumb money like Joe Sixpack investor gets in on tips from his friends and starts day trading and buying up stock and going on margin and stuff. Well, the reason that kind of mindset was made popular was because that's what happened during the technology bubble back in the late 90s and early 2000, when the market went into a top. People were day trading technology shares and bidding tech stocks into bubble-like valuations. And that's when the market finally went into a topping process and then went into a bear market. Now, what I think is incorrect about expecting Joe Sixpack to always come in late and be the final telltale sign of a market top is not, that's not always who is actually the latest money into a market or who's making the stupidest decisions in the market. If you look at what happened in 2007 and 2008, it was actually the financial institutions that got into the biggest trouble speculating on subprime mortgages, and they caused the financial crisis by going into tons of debt, and when that all went bad, the market crashed. The word is individual investors probably that were on margin back here too, but the big culprit was the financial institutions. Now, what's interesting about this bull market, and I'm not going to make any judgment on whether this bull market is over or not. There's people that are speculating that it is, and then there's people that say it's going to go on for a while longer. But what I think is interesting about this market is that U.S. corporations, I think in a large way are actually the dumb money in this bull market, because the amount of share buybacks going on across U.S. corporations is humongous right now. And even though Joe Sixpack is on a lot of margin right now in this market too, but it really is not U.S. financial institutions or day trading individual investors, but U.S. corporations that are making the biggest mistake in chasing share prices higher at any cost and buying back their own shares. And that's what I'm going to talk about next by showing you some information on this topic. If you look at this article right here talks about record buybacks hitting escape velocity. They talk about the persistent bid under the U.S. equity market caused by corporate management teams who, in a rush to take advantage of rock bottoming borrowing costs, have issued record amount of debt and plowed that proceeds back into buying their own shares, which artificially increases their bottom line and boosts their own equity-linked compensation in the process. So if you look at this chart, which is actually provided by Deutsche Bank, it shows that the amount of buybacks has been surging in 2015, and it's been at a high level ever since 2013. So corporations are buying back their stock like crazy right now, and we can see in this next graph down here that corporate buybacks, according to the recent projections, are actually hitting an all-time high since 2003. And if you notice in this chart, you know, a lot of the activities occurred in the last couple years when share prices have already been really high, after this bull market's been going on for a while. And, why weren't they buying back more shares back in 2009 when the market bottomed, or even like as, late 2012 when the buying opportunity in the U.S. markets was actually a lot better. Um, you know, just like greed in individual investing or in institutions, corporations are susceptible to the same thing, and they're buying back their shares high after the market has gone up a lot. And notice they made the same mistake back in late 2007. They were buying back shares at the highest amount right before the market went into a bear market. So corporations aren't any better at timing the market or making wise buying decisions of their own shares as individual people are. It's kind of actually quite remarkable. So, you know, this article talks about, are record stock buybacks too much of a good thing? And they basically talk about, like Peter Schiff has a quote here saying that money spent on buybacks is not available to purchase new plant and equipment, to fund research and development, or to spend on marketing and logistics. In that sense, buyback spending generates current earnings at the expense of future earnings. Buying back shares is a good way to goose current earnings, but it doesn't really do anything for the future, and really benefits existing shareholders much more than it does, future shareholders, because it benefits the people that already own shares, at the expense of having the capital to invest in the business. And they talk about how, you know, Japanese companies, for every dollar they spend on buybacks, they use $5 on business investment. And, European companies spend twice as much on capex as they do on buybacks. So American corporations are really the king of buying back stock right now. This article talks about, how the S&P 500 companies are actually plowing back almost all their profits into buybacks. Um, Written back in October last year, this says that the S&P 500 companies are poised to spend $914 billion on buybacks and dividends this year, or about 95% of earnings. I mean, that's remarkable that, the amount of buyback activity actually just equates to the amount of earnings in the S&P 500. This Bloomberg article has a great title in itself. It says American companies are in love with themselves. I mean, this goes on again to talk about how S&P 500 companies are blowing all their earnings into buybacks essentially. Um, you know, Buybacks are booming, but are corporate insiders buying back shares with their own money? This article talks about how they're actually not doing that because they probably realize themselves that um, these shares are overvalued, so they don't want them for their own accounts, but they don't mind buying them for the corporation. So companies are buying back shares of their own stock at a record pace, but corporate insiders at these companies are buying less stock with their own cash, which could signal that top corporate execs think their shares are a tad pricey. There's a huge disparity between what corporate insiders are doing with shareholders' money and what they're doing with their own money. Corporate America's willingness to commit record sums to prop up share prices signals confidence in their businesses, but the unwillingness of insiders to buy much with their own cash suggests they think U.S. stocks are richly priced. And that's another key point about all these buybacks is the S&P 500 is historically at its one of its most expensive points in the last 100 years. So, judging by that, I mean, people don't, these insiders know that buying these shares with their own money might be a bad idea for future returns, but they don't mind doing that for the corporation's money. There's even an ETF or, ETFs now that are involved with corporate buybacks, which, just again shows, a lot of times you'll see ETFs come out when ideas are popularized right at the wrong time, and I'm not sure how long some of these ETFs have been around, but just to see ETFs that are talked about that are focused on buybacks is pretty interesting. This article talks about how pension funds are starting to get annoyed with corporate America splurging money on buybacks. This says that a group of pension officials has raised the alarm over record stock buybacks of the nation's largest corporations. The coalition, warned that stock repurchases by major company hamper productive investments and threaten long-term growth. If the pendulum swings too far in favor of returning capital to shareholders, the future viability of the companies in which we invest may be placed at risk. So the pensions are starting to recognize that all this money spent on buybacks is going to hurt these companies for the future because they could have used this cash to expand the business and not just buy back shares. They talk about McDonald's here, and they say McDonald's has, basically repurchased 625 million of its own stock in the first 3 months of this year, or essentially 77% of their net income has been used to just repurchase shares. I mean, that seems just like it's getting out of control. And finally, this article from Investopedia really kind of lays down the law as far as why is stock buyback a bad idea in certain cases. And I encourage you to bookmark this article and go back and read it. But basically, they say buybacks work because buybacks basically work when they offer a good potential return to shareholders. And when would that occur? When you're buying something that's has value in it, not when you're buying something that's overvalued. So, basically when a company could get a better return from, expanding its own operations or doing something to enhance the business, then, if they just bought back shares instead because they're undervalued, then buying back shares would be a good idea. Um, but, essentially, what are the worst times to buy back shares? There's a lot of different reasons why buying back shares is a bad idea, and it really will hurt shareholders. The main reason they lay out here, the number one reason is when shares are overvalued, which is ironic because that's the basic condition of the U.S. stock market right now is overvaluation. So, buyback should only be pursued when management is very confident that shares are undervalued. After all, companies are no different than regular investors. If a company is buying back shares for $15 each when they are only worth 10, the company is clearly making a poor investment decision. So this is a key idea that corporations buying back shares is no different than investors buying back shares. Buybacks are dumb when they're just done to boost earnings per share, which is really what a lot of corporations are doing right now. Buybacks are dumb when they're done to benefit executives, when they're done using borrowed money. This is one of the main excuses right now that they're saying to buy back shares is that money's so cheap right now, so why don't corporations borrow a bunch of money and buy back their own shares and benefit shareholders? But in reality, borrowed money is borrowed money, so it doesn't matter if the interest rates are cheap. If you're borrowing money and going into debt just to buy back shares that are overvalued, you're making a dumb investment decision, even with low interest rates. So to wrap this all up, the bottom line is that, unfortunately, at the top of every market, there has to be somebody that's chasing to get in at the end. And then, the smarter money is the money that gets in earlier. And I believe that, U.S. corporations are one of the big culprits of who is the dumb money in the market right now. And I hope you found this valuable and have a good night.